For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Randy and Jake Floyd of Floyd Financial Group will be your guides for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Randy Floyd, Jake Floyd, and Jeff Shade.
Good morning. Thank you so much. Welcome to Show Me the Money, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. On today's show, we're going to be talking about current events, also the best way to take withdrawals in retirement. Then we'll talk about estate taxes, the silent wealth assassin, and we'll wrap it all up today by talking about what our initial consultation really looks like. My name's Jeff Shade, and as always, I'm just here to ask the questions with the words of wisdom and solid advice. They come from Jake Floyd and Randy Floyd of Floyd Financial Group. And I'll start with you, Randy. How you doing this morning?
Jeff, I'm doing very well. Just happy to be alive in the USA.
Yeah, me too. And Jake, how are you?
I am also proud to be an American, and I say that with a little bit of jest, but I am actually very proud to be an American in today's world, and I can't wait to talk about some of what that entails.
Yeah, likewise too, guys. We had Trevor on last week, and I understand Trevor heard himself on the radio. He was quite impressed with himself, huh?
Yes, he was. In fact, I think he told his dad this morning, good luck doing this without me. So
I had a great time. He is just such a smart young man. I mean, he's a chip off the old block, but I tell you, for 13, I couldn't get over how well-spoken he was and how much he knew about things that were going on in the world. So congratulations for raising a fine young man there. Well, as you said, we've only got about an hour here on the radio. We've got so much to talk about today. I don't know where to start. Well, let's start with the Trump-Musk bromance. It could be breaking up. So what's going on with Donald Trump and Elon Musk?
The big issue with Elon in general, and it seems to be with people understanding his condition, right? So Elon is on the spectrum. He has basically mild autism, right? He has Asperger's syndrome. And so he has this inability to read the room. And Trump is all about reading the room, right? He tries to get all these things that we're about to talk about done without any real action, right? By simply staging the room, if you will, in a way that suits his liking and suits his agenda. And so after he did this AI Stargate thing, Elon comes out and goes, none of those people have any money to put in. They're going to invest $500 billion. They don't have $10 billion between them. And so that's kind of the last thing you want to do to Trump during his party, is start raining on his parade. It doesn't make Elon wrong. It just means maybe you don't do that to your partner here, and I think some of that is a failure to empathize on Elon's part. So it'll be interesting to see where it goes. I don't think it's just over at this point, but at the same time, I'm sure that Trump will probably give him a talking to at some point here.
yeah, I would say this too, when a leader is in place, yes, a true leader needs to have resolve, but they also need to have the ability to have a lot of people around them that can give them instruction and direction. And then guess what their job is to pick from what's right and what's wrong and what fits and what doesn't from that. So I think we're going to continue to see that Elon will have some influence in the background and some ideas. Maybe not influence is even the right word, but some ideas, and Trump will pick up on some of those, and some of those he won't. And will it be heated in some cases? Every relationship Trump's ever had has been heated in some cases.
Yeah.
So why would that change?
Including the marriages at this point, too.
I think also one of the things that was striking this last visit I took to D.C. is one of the tour guides that we had in the Capitol. Mm-hmm. She was talking about all the fist fights that they used to get into on the floor of the Senate and the House, and back in the 1800s and even 1900s, even today.
Yeah,
you see it sometimes, but back in the day, it was not uncommon to get challenged to a duel on the Senate floor. And people think, it's nice and orderly like it is on C-SPAN all the time. These guys, a lot of them care deeply about our country, and they have differing opinions. And certainly back in the day where a lot of these guys were patriots, they're ready to go out on their shield over it.
Yeah.
And so I do think that tensions are high because everything is so important, and I think that iron sharpens iron, and I think it's going to be good for us over the long haul, but it won't be without some casualties here and there.
Yeah, well, doesn't Elon Musk hold an important position in Trump's administration? Isn't he heading the Department of Accountability?
Well, that's not really a cabinet position, or hasn't been in the past. Maybe it will be in the future. It should have been, but the Office of basically budgeting is supposed to control that, but they haven't done a very good job of that, and nobody can actually give anybody a good number on what's being spent where on any given day. So hopefully this little extra side piece that Trump has created will give us some hard numbers, and therefore we can really put some accountability to things.
Well, I mean, who wants to be held accountable?
I'm very shocked that hasn't happened until now. And you see what it resulted in, too, $33 trillion in debt. Well, let's hope that Trump and Musk do see eye to eye at some point here in the future. I have great hope for that because I think a Department of Accountability is long overdue. Okay, let's move on to the next topic here. This is a big one. This is a thing called DeepSeek. Why China's startup DeepSeek could spell trouble for NVIDIA and the AI stocks.
Yeah, last weekend, China had launched this DeepSeek app for the iPhone, and it rose its way up past, Facebook and Instagram and past X and became the number one downloaded app over the weekend. And ultimately, DeepSeek is kind of a ChatGPT competitor right now. But the part that's remarkable is there was a paper released with this that says that for basically $6 million, they were able to accomplish this. Now, that's incredibly disingenuous. And basically, some people may remember that President Biden had put sanctions on China to where NVIDIA could not sell China their best chips. So they supposedly did all this without the best chips, which is categorically not true. In fact, at Davos, one of the guys outed them and said they have 50,000 of the H100 chips, which is what NVIDIA is selling everybody in the U.S. And so, long story short, people just are freaking out a little bit about the fact that AI may get a lot cheaper, a lot faster. And so that has major implications for NVIDIA, has major implications for all the companies that do business with NVIDIA, if it's true, and that's a big if, okay? We're talking about China here, right? If you think about, you think Microsoft is really geared up and ready to start putting a bunch of Chinese national chips into all their inner workings, all their AI data centers and all that, and hope that somehow China isn't listening in, isn't ripping them off. You can't ask DeepSeek about Tiananmen Square. You can't criticize President Xi. It's a communist version of what's already kind of close to that in ChatGPT, in my opinion, but that's a whole nother discussion. But the idea that maybe it doesn't cost $100 billion to build a working data center that you can farm out to people are concerned about NVIDIA's margins. I think looking forward, when NVIDIA reports earnings, we're going to see that this is going to have zero effect on them. One thing I will say about it, though, is it's probably going to be a tailwind for Microsoft, Google, and these hyperscalers that are trying to build out their data centers. If anything, it will help them maybe do it a little bit faster, right? And they'll say, hey, for this price, you can use our NVIDIA chips, and for a much less price, you can use our DeepSeek chips and their software and that kind of thing. And so it should be a tailwind overall for the whole industry. Whether or not it's going to eat into NVIDIA's profit margins remains to be seen. Even if it does, I think it's going to take a little while before we're going to see that in the print.
Well, I think the other thing to throw in here, Jake, too, is one guy brought this up. He said, how many of the world, and in fact, and indeed, the U.S. CEOs, how many of those are going to want to entrust their potential business to the Chinese state right away? And I just don't think that they're going to want to do that. I mean, if I'm sitting here and I have an option to use something made in this country versus China, I don't own, and this may sound horrible, but I don't own Chinese e-bikes. Mm-hmm. I don't own Chinese wheels for my bikes, right? Because I don't trust them. And I think the same is going to be true for a lot of CEOs. And this LLM, as they call it for short, which is a large language model, as I understand what that stands for. Sure, the first time anybody creates anything, it's always harder than to replicate it later.
Especially using their own chips to do it.
Right.
Well, if we don't trust TikTok, I don't see why we would trust DeepSeek here, too. So we'll have to wait and see what happens here. Talking about current events with Randy, Jake, Floyd Financial Group. Next one is the ICE raids. Big headline, 5 Trendiagra members were arrested in Chicago. These are some bad fellows.
Yeah, they truly are. In fact, 5 seems like a pretty low number to me. I'm waiting to hear 500 of them and 1,000 of them. And I'm sure that if we knew the level of infiltration we have of these folks, it would be pretty amazing. So I'm waiting to hear some bigger numbers here. But like you said, these people are bad people. I mean, they're into everything from drug trafficking to kidnappings, holding people for ransom, bribery. I mean, all sorts of things. So I'm just saying, hey, kudos. Let's get them out of here as quickly as possible. If we know who these people are, do you want these people on your doorstep, Jeff?
No,
I don't.
absolutely
and I don't want them
not.
anywhere in my neighborhood, if I can help it.
Yeah, so that is one of the benefits of the ICE raids, is getting some of the drug traffickers and some of the bad people out of the country. Running short on time here, but I did want to talk about these tariffs here. Trump has slapped a new country with tariffs. That is going to be Colombia. Now, at first glance, I'm thinking about coffee and flowers and things like that we might have to pay a little more for. But if I understand things correctly from you, Randy, where else is Colombia going to go with this stuff?
Well, right. We're 4% of the world's population. We consume 25% of the world's goods. When it really comes down to it, it's going to be very, very uncomfortable for anybody to try to do business without us, because what if you knew tomorrow, Jeff, whether you're working at a job where you get a 25% pay cut, or if you own a business and you're going to lose 25% of your business? In what world do you like that, and when can you stand that?
Well, you can. Absolutely.
That's exactly
I agree with
right.
you completely.
You can't.
So I don't know how it's going to affect flowers this Valentine's Day, but I think I'm going to probably do something a little bit different here. But you're right. Colombian coffee, I can't tell. I'm not a coffee connoisseur like you are, Randy. I can't tell the difference between Colombian coffee and the store brand coffee.
So let me tell you about coffee. I am a coffee snob. And if you want to know about coffee, anybody listening, if you want to know about coffee, call me up, but be prepared to take 30 minutes to talk about a cup. But I used to be in the food business a very, very, very long time ago. Over 25 years ago, and was for 20 years prior to that. So coffee is one of those things, and Colombian coffee, every morning, I'll just tell you what my mix is. I use Dunkin', 1/3 and 2/3 Javalier medium roast Colombian.
Oh my gosh. You got some time on your hands here. I got enough time to throw the cake up with a store brand, and the old Keurig and go from there.
And then you got to use cold water to start your brew process. You got to brew it at 195 degrees plus or minus 5. And depending on the grind you get, you're going to brew it somewhere between 4 and 8 minutes. Anything over that, you extract bitter solubles.
You got a future as a barista here, Randy. Are you kidding me?
Well, we're going to need some new baristas, because all the they-thems out there, I think, are vacating the premises.
That's right.
Sorry, I reverted.
Well, I never knew that about you, Randy. You and I have known each other for many years, but I just assumed that, you got a cup of coffee and that was it. So that's an interesting side note there for you. Can't wrap up this segment here without talking about the Super Bowl. Surprise, surprise. How did the Kansas City Chiefs make it in again?
Yeah, how about those Chiefs?
Right.
Yeah, they are. They're good. I mean, let's just face it. Patrick Mahomes, what he needs to do it, he gets it done. I will tell you this, though, as I look around and I really look at all of the options he now has, from D-Hop to Hollywood, P. Ryan to run it, Hunt to run it, and Worthy had a great game, and that kid is just barely getting started. And, we got the defense, we got Chris Jones, since we moved Tooney over to left tackle, Mahomes hasn't been killed as many times.
I'll tell you who else gets it done, and he seems to be all healed up and ready to go for the Super Bowl, is Mr. Butker.
Yep.
That guy gets it done. I mean, you watch these other teams, they got a 29-yard field goal, and they're really iffy about whether it's going in. You back him up 20 yards, and it's 47, 49, and you can't tell if it was perfectly center, if it was just, an inch to the right. I mean, he just splits it. It's crazy.
Well, it's going to be the Eagles against the Kansas City Chiefs and the Super Bowl LIX. Let's see, L is 50, the X is 10, minus 1, be 59. That's going to be taking place in New Orleans on February 9th, 5:30 Central Time. Be watching for that. Well, that about wraps up this segment for current events, guys. Before we get into our part 2 here, I want to remind folks that if you're listening to the program this morning, you'd like to get in and sit down with Randy and Jake at Floyd Financial Group, talk about your journey towards a prosperous retirement. We have this thing called the Floyd Financial Group Retirement Review at no cost and no obligation for you. To get yours, make this call this weekend, 417-889-7233. Get on the calendar there. Ashley will call you back during the week and set up a time for you to come in and sit down with Randy and Jake, talk about your future as far as retirement goes. Nothing is off limits. We can talk about Social Security maximization, income plans, investments to support income, We'll cover it all, and we'll talk more about what that entails in the final part of our show today. Once again, there is absolutely no cost for this, no obligation. There is no judgment. We'll meet you where you are. 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Time for a break, gentlemen. When we come back here on Show Me the Money, we'll be talking about the best ways to take withdrawals in retirement when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Randy and Jake Floyd, with Jeff Shade.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about the question I get asked all the time: what's the best way, or how's the best way for me to take my retirement income?
That's right, Randy. It is finally time to start using the money that you managed to save and invest over the years, but you better be a little bit careful. Taxes are just one of the tricky parts. So, Randy, what is the first thing to consider when you're coming up with a withdrawal strategy for a client?
Yeah, the first thing we always do, Jeff, when people come in is we sit down and get to know people and really figure out what are they trying to accomplish as they hang up their cleats, so to speak, if we were playing football or baseball, and they're ready to go out and retire. What does that actually mean to them? Because we have a bunch of people, in here every week, and everybody's a little bit different, So some people say, hey, I want to go watch the grass grow on my farm. Some people say, hey, I want to travel. Some people say, I want to travel in my new motorhome. Some people say, hey, I just want to take 3 or 4 vacations a year and make them good ones. And, all that kind of rolls into what does our retirement income look like and where do we pull it from? So for most people, we have, Social Security. Some people have a pension. A lot of people have a 401k, or if you work for a school system or a government entity, maybe a 457 or a 403b plan if you work for a nonprofit. Maybe IRA money that you saved on your own, and CD money maybe that, has become a little bit more popular of late because of interest rates being a little higher. So all those things come into play. But the first thing that's first and foremost is how much income do we need? And we look at this from how much of it is taxable, how much of it is non-taxable. That's kind of where we start. We look at all that. We do what I call the initial part of the plan, which is discovery and learning about people and what assets they have to pull from.
I understand that according to a survey, too, that 22% of retirees say that they take withdrawals from their retirement accounts in a formal, sustainable strategy, while little more than half take what they need as they go. I wouldn't think that that is a pretty good strategy because, as you said, you have this money in all these different places, and how you withdraw that money, the sequence, really can have a dramatic effect on how long that money is going to last.
Jeff, as an advisor, I think this is part of where we have to know each client, right? And we have to understand how they operate mentally. It's not always the client's job to explain to us every single thing about the way they work. It's partially the advisor's job to say, okay, I know this person is very conservative and they're never going to spend this money because they have a hard time spending money as it is, right? And then I have people who are used to spending money. They're used to buying exactly what they want when they want. And so we have to kind of gauge each person as they come at us. But I do think, yes, it's better to have, a more steady strategy if you can afford to do that. But there are some people that have saved more than enough that can get away with doing this kind of ad lib, as I need it approach. And it does work for some people, but not for everybody.
One approach, I think, is to divide your money into 4 parts, and you start with an emergency fund, which is equal to about 10% of your net worth, and that's going to help you avoid liquidating investments to cover a medical issue or some other sort of large unexpected event. But the second part is your income, which, of course, would include things such as Social Security, pensions, annuities, cash, whatever investment withdrawals that you take from, say, a 401k, 403b to pay living expenses. So if you've got Social Security, maybe you've got a pension, some annuities, cash, and maybe some equities, where would you start there? Where is the first place that you should pull from and maybe eat that part of your investment portfolio up and let the others grow?
Yeah, so I think that one of the things we need to think about, Jeff, is in our best scenarios, we want to start thinking about this stuff at least 5 years before we actually do it. And what I mean by that is there may be some moves we need to make now that can help us reduce our tax burden permanently in the future. One of those things may be, hey, do we want to convert some money from a traditional IRA or a traditional 401k into a Roth. And the reason I say we want to maybe start 5 years ahead or maybe even 10 years ahead in some cases is if you have a lot of qualified money that we know for sure is always going to be taxed because it never has been, and we have some time looking forward, one of the strategies we look at is if we can remain in the same tax bracket and convert that money to non-taxable income over several years, that's a win for the rest of your life. That's aside from any investments and returns that we may have, because if we do the Roth conversion, and it makes sense to do. Now, let me say this. Not always does it make sense to do the Roth conversion. We have to look at people's current tax bracket versus what their tax bracket's going to be in retirement and weigh that out and see how much of that money we can convert. Now, it may not be that we can convert it all, but we don't have to convert the whole hog. Just a partial piece can help us long-term as well. But there's a lot of things to consider, and taxability, like you said, is one of the biggest things that we look at in figuring out how do we support the person's lifestyle that they want, that they need, that they desire, and keep them in the lowest tax bracket possible. So as we look at all these different asset classes that you brought up, we need to figure out what's taxable, what's not. There's municipal bonds, if those things can make sense for some people. Depending on the return on investment that people need, the different asset classes we will use will be much different.
We always get questions about Social Security, and of course that is going to be one of the major sources of income in retirement. And you shouldn't really neglect optimizing your Social Security, or at least putting some thought as to when you should take it. Should anybody ever take Social Security before full retirement age? What are some circumstances? Let's say you retire at 62, but your FRA is going to be 67. What are some of the reasons that you would not take it, and some reasons that you may take Social Security?
Yeah, for sure. So, maybe you have health issues, and maybe it's really hard for you to continue to work at this point. If you work a physical job especially, or there's even things that, let's face it, it doesn't have to be that you're out heavy lifting, working construction. Stress level can be something too that people get to where they cannot manage. So, we need to look at those factors and say, okay, how are we doing? Is it something you can sustainably do to try to get to age 67? That's first and foremost. The other thing is, do we really need to work to 67 to have the money that we need to live the way that we want to live? One of the things and one of the arguments that always comes up out there is, Social Security, at most, only 85 cents on the dollar that you collect can be taxable. And it may be that it's 50%, and for some people, it may be zero of that Social Security that's taxable. So we need to look at all those different factors along with other assets that people have to determine whether or not it's a good time to take Social Security at 62, 65 when we hit Medicare age. Many people wait till that age because they know then they don't have to worry about health insurance in their retirement age. They're going to get their Medicare and then get a supplement or an Advantage plan to support what it doesn't cover. But all these things come into play, and I always tell people there's the financial sense of things, then there's the emotional and the physical thing to do with their body and their health. And we have to try to balance all those things out to help people determine. So I guess really the answer to your question is, Jeff, it depends on each person that walks in the door, even down to husband and wife. Husband may want to do it, wife may not, may want to wait till later. But, there's just more to it than just, hey, when is the best day? And when is the best time to start this? Is it 62? Is it 65? Is it 67? You can push it to age 70 and get the maximum, but does that really make sense? And also, how long does it take, even if I wait for the larger payment, how long does it take for me to catch up with the income I gave up between 62 and 65 or 62 and 67 or 62 and 70?
Talking with Randy and Jake of Floyd Financial Group, we're talking about withdrawal strategies for the money that you've saved. And again, if you've got questions, 417-889-7233 is our number to request your no-cost, no-obligation retirement review. Sometimes you're forced to cash out. Actually, always you're forced to cash out with your investments because eventually the IRS demands that you take withdrawals and start paying taxes through these dreaded required minimum distributions, or RMDs, age 73 for those people born 51 through 59. Can you elaborate more on that for us?
Sure. The RMDs are something that, we have to have if we have a traditional 401k or IRA. If we do convert to Roth IRAs, we don't have to start even at that age if we don't want to. Now, let me say this. Most people are needing to pull income somewhere along through there anyway. But the RMD works this way. The government says, hey, based on your age, there's a divisor that we divide into the year-end account balance of your traditional IRA or 401k in many cases. There are some situations where you can delay taking withdrawals from your 401k or 403b until you actually retire. But they use that calculator to determine how much you're going to have to take out. So really at age 73, it's roughly about 4% that people must take out. So if you've got, for every $100,000 you have in an IRA, you must take out about $4,000 a year. And by the way, if you don't take it, it used to be a 50% penalty, but under the Secure Act 2.0, it is now 25% penalty if you don't take that. So that's a pretty big owie. So one of the things that we do for all of our clients here is we help them keep track of that to make sure they are getting those RMDs done.
Okay, so as I said, for people born between 51 through 59, they've got to take it at 73. But if you're born in 1960, it's a little later, isn't it?
Yeah, it's all the way up to 75. And who knows? It seems interesting to me, and I've always wondered about this. As they've pushed that age forward, if our government needs tax money, why would they delay it longer rather than making it earlier? Just a question I have in my mind. but it is our government at work.
Yeah, exactly. Don't try to understand it because that is going to be a very frustrating task. Also, taking withdrawals in a falling market, especially near the beginning of retirement, that means that those losses are going to be locked in, and offsetting them would require bigger gains in the market later. Sequence of return risk, I guess, is what I'm talking about here.
Yeah, for sure. Sequence of return risk is something we talk about in here all the time. In fact, many times people will come in and sit down with us in the very beginning, and they'll say, well, listen, how aggressive should we be? We hear you talk about needing to have some downside protection and some risk mitigation. Markets go up generally. Why don't we just put all of our money out there in the market and throw caution to the wind and let it rip, right? So when we hear that story, we always talk about this thing that you alluded to called sequence of returns. And a reasonable withdrawal amount from a retirement account is probably around 5%. On the internet, it'll tell you it's 4% adjusted for inflation each year. I will tell you it's around 5% is where we can start and probably adjust a little bit for inflation each year from there. But when we look at two guys that retire with $1 million, and if we pull out 5%, that's $50,000 a year. Depending on when they retired and what's going on in the market, one guy after 15, 20 years may have twice as much money as he started with, while the other guy can easily be dead broke after 18 to 20 years. Now you say, why is that? It's because nobody can control how returns in the market come in. So who would have predicted that the end of 2021 would be the height of the market? Then we had a 20% downturn. Then, of course, we rallied back the last 2 years to new highs. Nobody would have predicted that the dot-com bubble in 2000, 2001, and 2002, when markets were down 40%, nobody predicted that. Nobody predicted the financial crisis in 2007, 8, and 9. But those are the kind of things that derail good, happy retirements, okay? And so we always need to figure out what is the best mix for a person, how much should they take, and how much can they withdraw from the retirement savings that they have. And also, we need to factor in there, and we always do, how much risk can people stand emotionally? And that's one of our jobs as an advisor, is to help people understand that, yes, markets are going to be volatile. They're going to go up and down. Risk is a little different than volatility. We don't normally invest in fledgling companies with retirement assets. We're looking to find solid companies with growth potential, maybe dividends that are paid in some cases, but we're always looking for established companies. Yes, markets come and go, like interest rates, were low for 13 years. Then Jerome Powell raised them up from 0 to 5.5% in 14 months, and now we're ticking back down. Markets always change. There will always be volatility, so we have to build plans around the fact that looking forward, yes, we want to make gains when markets are good, but we want to be able to mitigate damage to your retirement accounts when things are not so good.
We're talking about withdrawal strategies with Randy and Jake Floyd at Floyd Financial Group. And gentlemen, I think our listeners may have some questions. If that is you've been taking what you need as you go, you're looking for a more formal, sustainable strategy, then we invite you to call us here at Floyd Financial Group and request your no-cost, no-obligation financial review to talk about withdrawal strategies and anything else you want to talk about. Our number, 417-889-7233. You can make that call this weekend if you want. Leave your name, telephone number. Ashley will call you back during the week and set up a convenient time for you to talk to us. Again, no cost, no obligation. Certainly, there is no judgment. We'll meet you where you are. Again, that telephone number, 417-889-7233. And as always, you can find out more about us online at floydfinancialgroup.com. Randy and Jake, we're going to take a break. When we come back, we'll be talking about the silent wealth assassin. It's estate taxes. All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready to climb a mountain of financial know-how? Good, because it's time for more Show Me the Money with your financial Sherpas, Randy and Jake Floyd.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money. And in this segment, we're going to be talking about estate taxes and really just estate planning in general a little bit to bring this back around so people understand exactly what we're talking about.
Right, and a lot of people don't understand estate taxes. It's sort of a death tax, and it seems unfair, but it is out there. Now, fortunately, here in the state of Missouri, we do not have a state estate taxes. We're one of 39 states that do not have those. But still, the federal estate tax does apply, so let's break it down here a little bit. Can you elaborate on exactly what an estate tax is, what the limits are, and how it's levied?
Sure thing. So at this point, the estate tax limit is pretty high, but let's just talk about in general what the estate tax is, or sometimes called the death tax, if you will. So let's say over your lifetime you've been very successful and you've built a large investment portfolio, you've got real estate. Well, let's go out there all the way. We got oil and gas wells, we got we got gold, we got everything, right?
Right.
So what happens is when you die, everything is added up. And they get this total, and if your total is in excess of what the federal government says you can have, then they assess roughly a 50% tax on all of that.
Oh, my gosh.
That's over the limit.
50%?
Right, so roughly half. I think it's actually maybe 45, but it's close enough to 50% to call it half, right?
Call it 50, yeah.
So in today's world, now if you remember, Trump put into place back in 2017 his tax cuts, right, that are due to sunset in 2025, which is this year. Now, everybody believes that he's going to extend those and maybe even give us some additional tax breaks. But what it amounts to is if you exceed the estate tax limit, you owe that big tax. So it's now, under Trump's rules, it's about $25 million that as a couple, roughly 12, I think it's 12.95 actually, so $26 million roughly, that a couple can give away and there is no death tax. Now that doesn't mean that your IRAs and things will not be taxed. Mm-hmm. You know, they certainly will be because those things have never been taxed. And as your people that inherit those spend that money, and there's a 10-year rule for that now for most of that, even on Roth IRAs, they must take a minimum amount out of there. And there's some real coaching that needs to be done if people inherit big IRAs as to how to take that money out to mitigate taxes in the best way. So anyway, going back to the estate tax, 26 million is not going to be very many people out there. But let's put it this way. If Trump does not get these extended and keep the current setup, if for some reason Congress won't pass it and keep it in there, it's going to revert back to 7 million. Mm-hmm. And so at 7 million, if you got 10 million out there on that 3 million, you're going to pay something like, $1.2 million in estate taxes. Yes, you heard me right.
You knocked me off my seat there a little bit. I was speechless. Yeah. That is incredible that we have this estate tax or this death tax. I never really knew that it was such a silent assassin here. And a lot of people do not think that, well, this doesn't apply to me, but you'd be surprised when you add things up over a period of time. As you said, it's not only maybe, what you have saved, but it's the value of the property that you have, and maybe you've got some leases or something elsewhere that could really creep up on you. So let's say that we're worried about the estate tax here. We want to minimize what we would have to pay in estate taxes. Is there a way that we can maybe whittle down that estate while we're still living?
Sure. So there's a couple things that we can do. We can give away money over our lifetime to our kids, or for that matter, anybody that you think you want to give money to. People have heard of this. There's a $19,000 per year. Way back in the day, it was $5,000, then it was $10,000, then it was $15,000. Every year it changes. Right now, we can give away $19,000 to anybody we want to. one person or any rake stranger we find. And if you're married, it's 2 times that, $38,000 that you can do. And you don't have to file a Form 709, which is a gift tax return. If you exceed the $19,000, and this is a key point for people, if you exceed that, you must file the 709 so that the government can keep track of how much money you've given away against your federal estate tax limit over your lifetime. So if you keep it under $19,000, let's say you got 4 kids and you're married, you can give away 4 times 19 times 2 because you're married. You and your wife can give that money away. So that's one way to help avoid estate taxes. Now, you have to be careful how you do that because if you're taking it out of an IRA, you're still going to pay taxes anyway. But it's something that people need to think about, and gifting is a good way to help mitigate some of those taxes. Another way is through careful estate planning and the using of trusts. Many times irrevocable trusts that can hold property and things that can remove that from your estate. And if you have a really large estate, there's also this thing called an ILIT. That's an irrevocable life insurance trust, where we can actually purchase life insurance where it will actually be held separate from our overall estate and help us, or help our kids, not us, our kids, or whoever's going to inherit our stuff, pay the estate taxes.
Now, I've just been handed a note here. It's actually a question from somebody listening to the program. It comes from a young fellow who says his name is Trevor. He is listening in Springfield, Missouri. Trevor wants to know, can his grandparents give him $38,000?
The answer is they could. I'm not sure that they will or they should. But
Okay. Sorry, Trevor. Yeah, he's a bright young man. We're looking forward to having him back. But, you're right. $19,000 per person, per recipient. So you and Lisa could give Trevor $38,000 before you had to file a gift tax return. Lifetime gift exemption. What is that? I mean, there's only a certain amount over, the $38,000 per year that you can give somebody. Is there an exemption lifetime on that?
Well, again, the exemption right now is $12.95 million per person. So if you're married, it's about 26. But again, if we don't get Trump's, tax plan extended, it may go back to $7 million. That'll be quite a bit lower, than where it is. But again, people listening that have that stuff to worry about, pre-planning and getting ahead of that is going to be a very crucial thing. And some of you kids that are listening, if you know that your folks and stuff have businesses maybe that they own or a lot of real estate and that sort of thing, you might say, hey, have you guys thought about this?
Well, you mentioned irrevocable trust, and I know that Elizabeth Floyd here is our estate planning expert here at Floyd Financial Group. Actually, she's an estate planning attorney. So again, if you have questions about estate planning, contact us here at Floyd Financial Group. Elizabeth will be happy to sit down with you and talk about that. 417-889-7233 is our telephone number. You can make that call right now if you'd like to set up an appointment with Randy, Jake, or Elizabeth here at Floyd Financial Group. Again, it's 417-889-7233. So we can gift the money away. We can use irrevocable trusts. What about a family limited partnership? Have you done many of those FLPs, and what are those?
Yeah, those are things that you can do. I will tell you that for closely held corporations and companies and things, the family limited partnership is a good way to transfer wealth over time. And it really kind of uses the same rules, only with a little bit more teeth. It just really allows us to transfer assets now and for those to be discounted looking forward. So the FLP, like I said, not something we can get into a lot of depth here on the radio show about, but definitely something that should have been mentioned. We also have charitable donations for those people that don't have, maybe family to leave things to. There's charitable trusts and things that can be done to provide income for you all the days of your life. And then in the end, it goes to the charity and you can get a tax break up front. So lots of different ways through estate planning to, I won't say that skin the cat, anyway, a lot of ways to approach this.
I know what you mean there, Randy. It is just an expression here. Talking with Randy Floyd of Floyd Financial Group. Again, we're talking about the silent assassin. It's going to be estate taxes. You mentioned charitable donations. Certainly when people think of that, they think of donating money, but there are other ways that you can donate to charity, or you can donate to other things, or even if you want a gift, as you said, you can gift cash, but could you, for example, pay school expenses or medical expenses? something like that and consider that a gift?
Yeah, you can, absolutely. That works just absolutely fine.
Okay, and let's say that I want to donate, not cash, but let's say that I've got some land. Maybe I've got highly appreciated assets. I've got stock, things like that. Is there a way that we can donate those to charity as well?
Absolutely. So we can do that. Really, there's two ways, but I mean, a charitable remainder trust is probably the best way to go about doing that. You can do it just through direct beneficiary designations. And again, if it's going to a charity, they're generally exempt from most all of those taxes.
Talking with Randy and Jake here, Floyd Financial Group. We're talking about estate tax strategies. And again, 417-889-7233 is our telephone number. So based on what we have talked about today, if someone is just joining us, Randy, and they've joined this conversation in progress about estate tax planning, can you really give us a little bit of a thumbnail summary of what people should be concerned with and how it may sneak up on them?
Yeah, well, I think first and foremost, whether you have the estate tax problem or not, if you don't have an estate plan, that's one of the first things you need to think about. And a lot of people say, well, I don't have much of an estate. I've always been told if I don't have $1 million or $2 million or something like that, I don't need an estate plan. And really nothing is further from the truth. Everybody needs an estate plan, which basically talks about, hey, who gets my stuff when I'm gone? And oh yeah, by the way, when I'm alive and if I'm not doing well health-wise or I need a nursing home stay or something like that, who helps me to navigate that and make sure that I get all my needs taken care of? So that's part of an estate plan. And then we can get into the estate tax planning and all that. So if you have a large estate and you haven't really done any estate tax planning, it's something that you need to do. And as Jeff alluded to, the Floyd Law Group, which is owned by Elizabeth Floyd, is who would actually help you through that. So people just need to sit down with an estate planning attorney and talk about where they are, let them get kind of an idea of what your asset balance is, and really help you navigate this in the best, most efficient way.
And there is the potential for significant estate plan changes, too, as the administration goes on. So if you have questions about estate planning, maybe you'd like to sit down with Elizabeth here at the Floyd Law Group and talk about your individual situation. Again, it's not going to cost you anything. No cost, no judgment. Certainly, there is no obligation. 417-889-7233 is our telephone number for Floyd Financial Group right here in good old Springfield, Missouri. You can also find out more about us online at floydfinancialgroup.com. Okay, Randy and Jake, time for a break. When we come back, we'll be talking about what this initial conversation consists of and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Randy Floyd, Jake Floyd, and Jeff Shea.
Welcome back, everybody. This is Randy and Jake. You're listening to Show Me the Money, and in this segment, we're going to be talking about, so Randy, if I decided to call and I wanted to talk with you guys, what does that look like and what happens at that first meeting?
Right. A lot of people don't understand that this is really just a casual conversation. So for those people who are just joining us, maybe they're new listeners, or maybe you've been a listener for a while and you're unsure what happens when you call 417-889-7233, Ashley calls you back and sets up a time for your appointment to sit down with Randy and or Jake at Floyd Financial Group. Let's explain what people can expect. First of all, Randy, what can they not expect from this first appointment?
Right. So number one, we don't make any decisions. And number two, we don't put the thumb on anybody to try to do anything. It's more of just an open conversation and a get acquainted type situation. The thing that I would really say is it's normal for people to be a little apprehensive. Many times, Jeff, people that come in to see us, they have worked a job their whole life. They've invested in 401ks. Maybe they're lucky enough to have a pension plan or something like that. But they really haven't ever really engaged somebody or a company like us in a one-on-one situation. So they're apprehensive. They just don't know what to expect. And I always allude back to this. We had this lady years ago. We were sitting down, we were talking, and then all of a sudden she said, so now we have to talk about scary money stuff, huh?
Yeah.
And so our goal is to take the scary out of the scary money stuff, because sometimes what we don't understand and what we don't have a basis or a knowledge about, that's what we want to do, is help educate people and get them comfortable with what their choices are looking forward. So the first thing we have to do, we call it discovery. We have to learn about those people. Learn what's important to them. Look at what they're trying to accomplish and what their end goal is. That's first and foremost.
And the discovery process is so important because you don't have just a blanket plan for everybody here. We have to find out who you are, what your needs, your wants, and your goals are. And I think a lot of people think that, well, when I come in for this consultation, I've got to bring my tax forms and all this other stuff, W-2s, 1099s, whatever it happens to be. And in one session, we're going to figure out what I need to do for my retirement. Couldn't be further from the truth. It is a several session process. And I think if I'm hearing you correctly, Randy, what you're saying is that this first session is a very, very casual conversation. I picture you sitting there, no tie in the office, and you're just chit-chatting, you're having a little coffee, something else to drink, and you're just getting to know people. Is that about what this first consultation is really all about?
That really is exactly what it's about. And we often tell people, anything you want to ask. I mean, we're an open book. We're a fiduciary here. We want you to know why we do things. And so we're really pretty big on explaining things. We think it's important that you know what we're doing and why we're doing things with your money.
Okay, so this first session is purely just get to know us. We get to know you. We find out what your goals and your dreams are. It's the discovery process. And what does that take, an hour, a little less than that, something like that?
Generally, we're going to allow an hour to an hour and a half for those type of meetings, especially the initial ones, because, again, sometimes just starting to break the ice and getting to know people, just takes a little time. And then when we really get kind of going and down into it, we don't want to run short on time. So if we don't need the hour and a half, hey, we're good. But if we do, we generally have that time.
Okay, so let's say that I come in for the appointment. We have this hour and a half conversation. I mean, are you forced to make the second appointment at that point in time? At what point can you just say, thanks for your time, I'm going to go think about this?
Yeah, for sure. People don't have to commit to doing anything at that point. Generally speaking, what happens, though, I will just tell you, 8 or 9 times out of 10 probably, is we get to know people and they say, okay, here's kind of where we are. Here's what we're thinking. We got 5 years to retirement. We got 1 year to retirement. Or, hey, I'm retiring next month. We hear that once in a while too. So depending on what the situation is, we will schedule that next meeting from there. I often tell people, not everybody is for us and we're not for everybody, right? And we know that. But generally speaking, 9 times out of 10, we're going to have another meeting. And that's where we're going to really start to get down to learning what they have asset-wise to work with and learn about their risk tolerance, their ability and desire to want to or not to want to take risk and market volatility. We'll just start with what we call analysis there and really getting to know them. And then that'll lead us to the third part of the planning stage. And sometimes that happens at the second meeting, but sometimes it's a third meeting.
So you've discovered me in the first session there. We've decided that we want to move forward here. And the next step, as you said, is the analysis. And I would imagine that that's where you need a little bit more information about what you've got and where you want to go. So you're going to do that. Now, some of this is going to happen behind the scenes. The next is going to be planning. So once you make this plan, do you call somebody back in for another meeting to present that plan? And how do you illustrate exactly what you propose to do?
Sure. So yes, we absolutely have people back in. And then, it's not like, okay, this is the plan, slam, bam, that's not how it works.
Right.
We talk about this is what we think is right. This is how your income flow will be, where your income will come from, what it adds up to be, what your tax picture is going to look like. And then they're going to ask questions. And they always have a lot of questions. And so we want to answer those questions and help people drill down on why we, did the plan this way, and we'll tweak it a little bit to where it suits them is really what it gets down to.
So we've done the discovery, then comes the analysis, we've done the planning, we've explained it to everybody exactly what we propose to do, of course, answered any questions that you might have, made any adjustments based on your risk tolerance or any other parameters that you may throw at us. And if we decide to move forward, then comes the implementation. So how do you do that, and does the client have to be there for that?
Yeah, so implementation basically is where we know what we're going to do, and then we have to, it's been said, there's no job done till the paperwork's done. Of course, that's changing some. It's now no job's done till the DocuSign is done. Because a lot of times this stuff is done online now, right?
Sure.
And people electronically sign and things like that. But everything we do here is designed to make it easy for the client to then transition, and if they're retiring right away, to get their income stream started, to get it direct deposited to their bank account, to, if they want us to, withhold taxes. Depending on the situation, that makes sense sometimes. Sometimes it does not. They're already paying quarterly, or maybe they have income from a business or something like that, to where it doesn't make sense to just do straight up tax withholding. But for a lot of retirees, when we know how much their Social Security is going to be, maybe what a pension is going to be, and what we plan to draw from the retirement accounts, we can pretty well calculate what we need to withhold for taxes and all that, and make it very simple, very straightforward. And we handle all the behind-the-scenes stuff to get all that set up and accomplished.
All right, so we've done the discovery analysis planning. We've implemented our plan. Finally, what does the follow-up consist of? How frequently should we be in touch with you, or you be in touch with me?
Sure. So yeah, the follow-up is very important, especially, when clients are brand new and, we've just gotten started and we've just set up their income stream. We're going to schedule our first review generally 90 days out. And now, obviously, along the way, any questions that come up, any little hiccups or things or something they didn't think of, as that comes up, they can call us anytime and we can help them navigate or fix anything. But generally, it's going to be 90 days, and then we'll come in and we'll sit down and say, okay, here's where we started, here's where we are, how's your budget looking? Because after 90 days, they're going to know, well, I maybe got a little more cash flow than I needed, or maybe I need a little bit more cash flow than we talked about. And then we'll review all their investments and how they're doing, and really give them a good snapshot as to where we are as of that day. Then from there, we'll book our next meeting. For some people, they'll say, hey, let's go 6 months. For some people, it's 90 days. We just kind of meet people where they are. We have clients now that we've had for, 20 years that say, you know what, Randy, if something, goes awry, call me. Otherwise, we'll do an annual review. So we just meet people where they are, and really where they need to be to feel comfortable with their situation.
All right, so this is a lot of work that you do for people. You provide a lot of value, certainly. And I think one of the fair questions that a client could ask is, okay, you've helped me so much. How much do I owe you?
So generally speaking, the way it works is, we manage assets in the market and in bonds and that sort of thing. And we house most of our assets at Charles Schwab for that sort of thing. It's 1% per year for our services there. That's all we charge, and that is in this marketplace and around the country. That would be, we're a low-cost provider.
Right.
We do the asset management here. We have a lot of tools provided by Schwab, and a lot of tools that we purchase to get information about investing and that sort of thing that we use on a daily basis. In some cases, there may be some fixed instruments and things of that nature that we will use where there could be an upfront commission paid to us. However, we always make sure that it's not something that comes directly out of the client's pocket.
Right.
So we do get paid, and we do earn our keep by helping people retire and stay that way.
Right. Well, I think that's a very important fact there, is that you help people retire and stay retired. And, when you really think about 1%, if I did this on my own, I probably wouldn't be very efficient at doing that. But if I have you do it, I may make 3, 4, 5, 6% more than I would be doing it if I were doing it on my own. So if you're going to give me an additional 6%, I'm happy to pay the 1% on an annual basis. So as you said, this is a lot of value for very, very little money. If our conversation has intrigued you and piqued your interest, again, we invite you to give us a call here at Floyd Financial Group. Request your no cost, no obligation, and no judgment appointment with us. 417-889-7233 is our telephone number. You can make that call this weekend. Leave your name, telephone number. Ashley's going to call you back during the week and set up a good time for you to come in. It's the beginning of the year. Why not get things off to a good start here for 2025? As I said, no cost, no obligation, no judgment. Once again, 417-889-7233. And why don't you go on out to the website, check us out, put a face with a voice at floydfinancialgroup.com. Well, Randy, Jake, we've had a great conversation this morning, but as always, we just get started, and then the clock says, hey, get on out of here, guys. The next show is ready to come in. So for Randy and Jake, I'm Jeff Shade. Have yourself a great weekend, won't you? And be sure to join us again next week for another edition of Show Me the Money right here on 104.1 FM KSGF, where Springfield comes to talk. The information provided in the preceding program is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning is offered through Floyd Financial Group, LLC, an SEC registered investment advisor.